Hi, everyone. I'm Rick Bensignor. Today is Tuesday, February 22nd. Welcome to this week's In the Know Trader Show. Lots going on in the markets. The S&P futures had a just about a 150-point range overnight before the 9:30 New York Stock Exchange session even opened. A phenomenal move. Right now, futures are down about 25 points or so. U.S. 10-year yields at 1.94. Crude oil up $2 on the day. Bitcoin is down almost $2,300, and gold is up $2 or so as we start our Tuesday session here. In this week's show, our trader education portion, we're going to talk about risk management and how it is as important as ever, given the type volatility and moves that we're seeing these days. In our market overview, we'll take a look at the Dow Jones ETF, the U.S. 10-year, and the up move we've seen in the last week or two in gold and what it suggests. And then I thought, given everything going on, let's spend the sector focus portion on looking at the 11 macroeconomic spider sectors: materials, communications, energy, etc. And we'll go through all 11 charts so that you can see the difference between each one, which ones look better than others, and some of the key levels. To sign up to get my weekly ETF report, the Tactical Trader Report, generally comes out Thursday evenings. Occasionally I change that, but most of the time you can count on it coming out on a Thursday. Or the monthly 7-Eleven report, which comes out on the last day of the month. Go to inthenowtrader.com and sign up there. Go to the sign up tab. I know there is an issue with the, what's that other tab that kind of describe, it's the services tab. That is, we are working on it. We've got a real issue with it. But the sign up tab works, and you can go there to sign up to get in-depth details on these two, to get the information that's in-depth on these two reports. The weekly one goes through the entire macro picture of everything going on, plus gives a new ETF trading idea each week. And the 7-Eleven report, the goal there is to outperform the S&P over time. And we continue to do that. We are up, I think it's about 1.4% going into February for our fiscal year, which is August, starts every August 1st. And since we started in August of 2020, we are outperforming by over 400 basis points. So if you want to do better than the market, then that's the place to go. Let's take a look at just a quick look at the macro sectors right now. Year to date, there are 3 standouts because everything else is kind of with the rest of the pack. The S&P itself is down 8.58% coming into today's action. This is that's the spiders. Obviously, standouts are energy up 22.6%. Staples only down 1.4%, and financials up just a tad here at barely 0.5%. Everything else is really getting knocked, and pretty close, performance all around, with looks like communication services and real estate as your really worst performance, and tech, of course, down to over 12% too. The thing is, the standouts here are the ones that are positive, or Staples, which is just barely negative, and that's where you're really getting your alpha, at least in the first 7 weeks or so of this year. Okay, so let's go to our trader education portion and talk about the importance of risk management, because when you get volatile days and weeks like we're seeing now, when you think about just the range that the S&P futures have today, which is just shy of 150 points, you're talking about over or just in the neighborhoods of a 3% move simply since Friday's close. Now, of course, the U.S. market was closed yesterday. Futures traded, but the U.S. market was closed, so some of that movement is built in from yesterday, but nonetheless, a monster type move. And when you have moves like this, you've got to really kind of figure out how to manage risk and what the things are that are most essential to being successful in managing risk, because in the end, that really is what makes or breaks your success as a trader and investor. It's understanding how to manage risk. And when you've got volatile days and weeks like we're in now, it's more important than ever, because it's very easy in an ongoing bull market to not feel like you really have to do that much. But when you realize that the first week in January, the S&P made an all-time high, and it's only in the last 7 weeks that things have really changed. You think like, oh, all right, well, I've only had to really pay attention to what's going on in 7 weeks. But in reality, if you've got a diversified portfolio, and I assume most of you do, and you have exposure to technology, although the tech index, like NDX, the NDX 100, or the NASDAQ 100, is made highs not that long ago. Also, the average technology stock peaked in February and March of last year. So you've been needing to manage risk for a heck of a long time now. It's really a year that tech has been hit hard. And if it wasn't for the few FANGI and mega high cap names that have dragged the index higher, most names have gotten pummeled. So it's really important to manage risk. So let's go through a bunch of things that I thought about this morning in putting this slide deck together that are important when you consider this whole concept of managing risk and how essential it is to your overall performance. First off, especially nowadays, don't marry your positions. You could put an idea on and think it's a great idea, and it could quickly turn against you because the whole market's under significant pressure these days. And it's really important to think about trading more in the shorter term time frame. And I don't mean you have to day trade, but putting on something now, thinking that in 6 months, a year, or 5 years from now, it's the right position, I'll tell you, that's a difficult task. And I think it's better to think about anything that you're putting on now is more of a shorter term type idea, and don't get stuck into something, especially that's not working for you, because it's very easy to buy something. You do your homework, you do your analysis, you put on your trade or your investment, and you think it's the right thing. And all of a sudden it's 10, 20% against you. And you start going into hope mode. Well, I hope it comes back. It should come back if the market rebounds. And you give the whole story in your head. And the reality is right now, you put an idea on, that's fine. You should be trading and taking advantage of some of the big moves that are happening. But if they're not working out, it's probably best to get out of, and not to bury some, concept of an idea that you think is going to have lasting, what's the right way of saying it? Kind of just being in it for the long haul, because right now we don't know what the long haul presents. And with the Fed tightening and war at hand in Russia, Ukraine, it's a difficult thing to figure out, what's coming down the road. Second, when you get into something, or before, actually much better said is before you enter your trade, look at what your potential losses are. Don't think about the gains. You're not going to buy something and say, oh, gee, I could make $8 if I'm right. The most important thing to do when you're in a volatile environment like we are is to focus on what could my losses be. That's really where you want to focus, so that if you're going to buy something down against support, and you go, well, let's see if I'm right, and I buy the bottom of the range and it goes all the way to the top of the range, they're going to make X amount of dollars. I'd be much more concerned about now what happens if the bottom of the range doesn't hold. How quickly will this stock fall? Where can I expect to get out at a reasonable price? Are we going to hit it in the air pocket where things fall apart quick, or will it, slowly trade lower because there's a support level underneath the one that I'm leaning on, and then, I still should be able to get out? Focus on what the losses could be. The gains will take care of themselves, but don't do this in the opposite direction about focusing on how much you could make and not thinking about the losses. Next one is use stops. I think you've got to use stops in an environment like this, but you also have to understand the risk in using them as well as using or not using stop limits. So let's talk about that for a second. If you're trading something and you put a stop in now, $1 underneath, you bought it because let's say there's really strong support. You think the stock's pulling back, it's going to hold $60 a share. You're going to put your sell stop at $58 in case it doesn't work. Realize, given the marketplace we have now, that you may not be filled at $58. You may be filled at $55, depending upon how low that stock may open on any given day. And it could have to do with just what the S&P has done overnight, or let's say the NASDAQ, or it also could have to do with if your company has an earnings report. You've seen in the last month or so since this earnings season started, certain stocks get absolutely demolished if they don't get the earnings or revenue numbers that the street is expecting. Doesn't mean it always happens that way, but your stock can open 25% down on a day if they miss earnings. So if you're going to use stops, realize that you may not get filled at where you think, and just putting in a sell stop underneath where you're long or where you want to stop yourself out doesn't guarantee that you are going to get filled anything close to your stop price. That's number one. Number two is, well, then use a stop limit, which says, given the prior example I just gave, you buy your long at 60, or if it breaks 60, you want to get out, you put your sell stop in at 58. Every order entry platform lets you put a limit to a stop. So you could say, you can put your sell stop in at 58, but you could set a limit at, let's say, 57.5, saying, I'm willing to sell this all the way down to 57.5, but not lower than that. In which case, if your stock opens at 57, it's not going to fill you. And it will then become a limit order at 57.5 if it bounces, and you'll get stopped out at 57.5. The risk to that is that the stock doesn't bounce to where your stop limit is, and it keeps going lower, and you're still in the trade. That's how losses can pile up. So pros and cons to using stops and stop limits. I think you've got to use stops in an environment like this, but realize too that if you hit an air pocket, things can get filled very far away. I know, I've traded commodities myself for years. I trade something like crude oil and natural gas fairly consistently, more so than I do, let's say, gold and silver. I also trade the grains. So, I kind of have a broad exposure across commodities, but I know that in crude oil, there are times that crude oil can run $1 to $1.50 in a split second on a news headline. And you're not the only one putting in a stop order. So it's also, where you are in the chain of stops, and you could easily get absolutely destroyed using a stop relative to where you thought you would get filled. So yes, I use them. I think you have to, but understand the risks to using them, understand the risk to not using a stop limit, that you could really get filled very far away, but also realize that even a stop limit doesn't necessarily mean you're going to get filled. Widen parameters for entry and exits, scale them when appropriate. So in this type environment, there is not one and only one price to buy a stock you're looking to get into. And the same thing as far as getting out. So I often will scale down bid. Let's say if I want to buy a stock near 60, I may start at 60.5, and every 10 cents from 60.5 to 59.5, I put in an order. And this way, if it all happens, I get my average price. But let's say we only sell down to $60.10, and then the stock turns around and shoots to 65. If you had a $60 limit on your entire portion, the entire trade, you've missed it all. I think with the volatility, it's a good idea to scale yourself in and scale yourself out of trades. There is not only one ideal price. Same thing. You miss it by, a couple ticks and you've missed the whole chance to get out. So given the fact that it costs nothing to trade these days, right? All of you should not be trading, should not be spending a single penny to get in and out of your stocks. And if you are, go open an account somewhere else and pay nothing to trade. And whether it's Fidelity, Schwab, Ameritrade, Interactive Brokers, Merrill Lynch, I mean, all these places have free trading platforms where commissions are non-existent. So there's no additional cost as far as commissions to scale in and scale out of trades. It's not like the old days where every order cost you a certain amount of money. You didn't want to scale necessarily because you didn't want to keep paying commission. That is not an issue any longer. Therefore, in these type markets, I scale in and I scale out. Next, medium-term trading, meaning multiple months, putting up positions that you think you'll be holding for multiple months, is very difficult when you have an S&P with a 150-point range before the day even started. So think about this. In a couple days now, you could easily see what used to be weeks, if not a month or two, of typical range. It can happen very, very quickly. So you also have to know yourself. If you don't like trading, or you can't trade because you can't be in front of your screen all day long, you have a job that's demanding and it's not full-time trading, so you can't watch everything all the time, then don't trade because you don't like it or you can't trade. But what you can do is still review your portfolio and manage your portfolio. Get rid of the crap that's in there. We all have a bunch of names that we wish we never owned that have underperformed. Use rallies to get rid of them. It'll raise cash so that you have opportunities to get into ideas that you want to instead of hoping and holding on to something forever. Now, there are tax implications if you sell stuff from your portfolio. It could be short-term gains or losses or long-term gains or losses. And what I try to do is when I take something out of my portfolio that's just been junk and is, I may have to wait years to ever see something come back to the price I paid, then if I dump out of that and I take, let's say, a long-term loss, then I'll often try to take a long-term gain against it. I lock in the profits on the gains. I take my loss, I lock in the loss, but from a tax perspective, they wash each other out. So I try to do similar dollar amounts of gains and losses in order to do that. If I have a short-term gain, let's say I had a terrific trade, I buy a stock at $60 and it goes to $80 in a week. And I go, boy, there's resistance at 82 and it's probably not getting through there. I'm going to take my gain. That's a short-term gain of $20. Let's say you bought 100 shares, that's $2,000. I might very well take a $2,000 short-term loss to offset it so I don't have to pay the tax on the short-term gain. So, when I say to manage your portfolio's risk and take profits and losses, I also think about, I'm not a tax advisor, so talk to your accountants if you need help on this, but I try to think of it in terms of, if I'm going to take a gain, is there something I can also do so I don't have to pay tax on the gain? Can I take some loss against it? Next is, and this I would highly encourage you, learn how to use the options markets to manage your risk, not only on positions you currently have, but also to enter new positions. As you learn the options market, it's a derivative market. As you learn how to use derivatives, futures are derivatives also. One of the flexibilities of options is that you have the option to do something, but not the obligation. So whereas futures, when you buy or sell a contract, you have the obligation to make good on that at expiration if you haven't gotten out of it. Options, you don't need to. You have the option to do what you bet would happen, but you don't have to. And you are essentially paying a premium. If you're buying options, you're paying a premium to get into that particular trade, whether it's a bullish trade or a bearish trade. And the person who sells the premium, think of them as the insurance company. They're collecting premium on the chances that they won't have to pay out that premium. They would have the obligation, but as the buyer of an option, whether a bullish option or a bearish option, you have the option as the buyer to actually do what you've gotten into. There's huge advantages to it, and there's huge advantages to playing markets that are volatile as this, because using options, you can limit your loss. If you buy a call, which is the right to buy a stock at a higher price, let's say an out of the money call. So if a stock's trading at 100, if you want to buy the right to be able in the future to pay 105 for that stock, you're going to pay a certain amount of premium to have the right to pay 105. And in the future at expiration, if the stock's trading at 107, yes, you're going to exercise your right to pay 105 because you've got a $2 profit built in there. If the stock's trading at 103 come expiration, you're not going to say, I want to buy the stock at 105. So you've only simply spent the premium that you originally laid out in order to have the right to buy the stock at 105. That's the advantage of options, is you can limit your risk if you were a buyer of options. You can't lose more than what you laid out to get into the option, regardless of which way that stock moves. So in markets that are really volatile, I highly suggest you learn how to use options market and take some time to learn. There's a ton of courses online. There's a terrific website called Options Play that has great options instructional videos. So I'd recommend you go there, and it's something to pay attention to. Next, whether your last trade, and it looks like just based on time, I don't think we're actually going to get to many charts because we've spent the bulk of the time here on risk management. And what I'll do is I'll just push that off to next week. We'll do all the 11 sectors and take a look at the markets next week. But this stuff is so important that it really was worth dedicating the entire time. And I never quite know how long these shows will take on the educational portion. It just depends on how much I get into it. But this, if you're trading markets, this is important stuff to know. So let's take a look at this one. Whether your last trade was a winner or a loser, it should have no bearing upon what you do in your next trade. Doesn't matter if you lost money. You shouldn't get any more tentative because you lost on your last trade. At the same time, if you made money on your last trade, that doesn't mean you can play with, quote, house money on this trade, because let's say you just made $500. Well, now I have $500 to blow. No, if you do that, you will assuredly blow your $500. Each trade is an independent trade. It should have, in a perfect human being's mind, which we are not, but this is the goal, it should have nothing to do with what you do next. So if you lost money or made money, that trade is done. You've closed out. It is done. Forget that and simply pay attention to what you need to do, starting fresh right out of the gate, as if it was trade number one that you were doing. And you do all your analysis, and do not think of there's house money involved here. Bad concept, because you will almost always lose that house money. And lastly, and importantly, and again, these are just things that came up in the last hour just before the show when I put this together. There's plenty more. Enjoy the game. And if you don't enjoy the game of trading, then don't play it. It's really fine. Trading is not for everyone. Investing should be for everyone, because over time, there's nothing better you can do with your money if you have multiple years and decades as an investment horizon. You will be very glad that you were invested in the stock market. But if the shorter term game of playing, and days like we're having now, where just before the show started, the S&P was up, 10 points or so. It's now down 27. It's all over the place. If this stresses you out, then, short-term trading is not for you, and that's fine. It's really not for everyone. In fact, it's not for most people. and learn to know what your strengths and weaknesses are in life, certainly, but specifically in this case for trading. And if this really, brings you undue stress watching the market and your head is glued to the, your quote board tick by tick, it's not for you. And that's fine. Just, manage your investments. So think about that too. If you're going to play the game, enjoy it. It can be very fun. And that's it for this week. I really appreciate you tuning in. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.